Hello and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. Today we're discussing several important changes coming in 2026 that may affect retirement savers, especially those contributing to IRAs, 401ks, 403bs, 457bs, and HSAs. These changes are not just technical updates buried in fine print. They may create meaningful new opportunities to save more, build more, and strengthen your long-term financial picture if you understand the rules. During today's show, we'll be referencing a recent Kiplinger article, 6 Changes to IRAs, 401ks, and HSAs in 2026. Let's begin with what we believe is one of the most impactful changes coming in 2026, mandatory Roth catch-up contributions for high earners. Beginning in 2026, individuals age 50 or older who want to make catch-up contributions to a 401k, 403b, or governmental 457b will face a significant shift. If your prior year FICA wages with the plan sponsor exceed $150,000, which is box 3 on most W-2s, then every dollar of your 2026 catch-up contribution must go into the Roth side of your plan. This means those contributions will be after tax. The pre-tax deduction that many high-earning savers relied on will no longer be available once you cross that income threshold. The benefit moves from the front end to the back end. You'll pay taxes now, but qualified withdrawals in retirement may be tax-free. The income threshold will adjust for inflation over time, but the rule itself is permanent. And with the catch-up limit rising to $8,000 in 2026, up from $7,500, high earners who fall under this rule will need to ensure that full amount is designated as Roth. There is no pre-tax option. One more important detail. If your employer's plan does not offer a Roth feature and you meet the high earner criteria, you simply will not be allowed to make catch-up contributions at all. That's a critical item to review with your plan administrator. If you're near that income level or expect to cross it, 2026 may be a good time to reevaluate your saving strategy and coordinate with your financial and tax professionals. Next, let's talk about increased contribution limits coming to employer-sponsored retirement plans in 2026. The 401k, 403b, and 457b contribution ceilings rise periodically, but the 2026 adjustments are especially meaningful. Higher limits give savers more room to add to tax-advantaged accounts, potentially boosting long-term compound growth and creating more opportunities for strategic tax planning. Here are the 2026 numbers. Employee contributions under age 50, $2,400. Catch-up contributions, age 50 plus, $8,000. Total for ages 50 plus, $32,500. Super catch-up for ages 60-63, $3,250. Total for ages 60-63, $35,750. That special 60-63 window is part of Secure 2.0 and provides a temporary opportunity for individuals nearing retirement to save more in the years when their income may be at its peak. These increases arrive at a time when many workers are concerned about the long-term outlook of the Social Security Trust Fund. Some estimates suggest individuals may need as much as $138,000 in additional personal savings to generate the same income in retirement if benefits are reduced. That's why higher contribution limits can be meaningful. The changes don't stop with workplace plans. In 2026, both traditional and Roth IRA contribution limits rise as well. For 2026, IRA contribution limit under age 50, $7,500. Catch-up, age 50 plus, 1/100. But understanding IRA rules requires paying close attention to income limits because they affect whether your contribution is deductible or, in the case of Roth IRAs, whether you can contribute at all. Traditional IRA deduction rules. There is no income limit on contributing to a traditional IRA, but whether you can deduct your contribution depends on 2 factors. Whether you or your spouse is covered by a retirement plan at work. Your household income. If neither spouse is covered by a workplace plan, you may take the full deduction regardless of income. If one or both spouses are covered, 2026 introduces new phase-out ranges. If you are covered by a workplace plan, single or head of household, full deduction at $81,000 or less, partial from $81,001 to $91,000, no deduction above $91,000, Married filing jointly, both spouses covered, full at $129,000 or less. Partial from $129,001 to $149,000. None above $149,000. Married filing separately, full below $10,000. None at $10,000 or above, if only one spouse is covered. Married filing jointly, full deduction up to $242,000. Partial to $252,000. None above $252,000. These increases create more flexibility, but they also make professional guidance valuable, especially for households near a phase-out range. Roth IRA eligibility limits. Roth IRA contributions are not about deductibility. They depend entirely on your modified adjusted gross income, MAGI. For 2026, single or head of household, phase out from $153,000 to $168,000. Married filing jointly, $242,000 to $252,000. Married filing separately, below $10,000. If your income falls within these ranges, your contribution may be reduced or eliminated. Given all these moving parts, 2026 may be an appropriate time to revisit your IRA strategy and understand where you fall within the updated thresholds. Retirement plan opportunities for small business owners. Now that we've covered personal retirement accounts, let's shift to something just as important: retirement plans for small business owners and the self-employed. This group often faces more complex planning challenges than traditional employees, and we think the 2026 updates offer some of the largest potential benefits for them. Higher contribution ceilings mean there is more room to save in tax-advantaged accounts, both for owners and for employees, which can help improve financial security and strengthen employee benefits packages. Simple IRA and Simple 401k limits for 2026. Employee contribution limit, $17,000, up $500. Catch-up for ages 50, 59, and 64 plus, $4,000. SEP IRA updates for 2026. Maximum annual contribution, $72,000. Compensation cap, $360,000. SEP IRAs do not offer a super catch-up provision. Solo 401k updates for 2026. Employee contribution limits. Under age 50, $24,500. Ages 50, 59, and 64 plus, $32,500 includes $8,000 catch-up. Ages 60, 63, $35,750 includes $11,250 super catch-up. Employer match profit sharing, up to 25% of compensation for all age groups. Total combined limits. Under age 50, $72,000. Ages 50, 59, and 64 plus, $80,000. Ages 60, 63, $83,250. And remember that in a solo 401k, you can contribute as both employee and employer. The compensation cap for 2026 is $360,000. For many business owners, these higher limits can make 2026 an appropriate time to reassess their retirement planning strategies and ensure they are maximizing available opportunities. A smaller but noteworthy change arrives in 2026 regarding plan communication. Defined contribution plans like 401ks must send participants at least one paper statement per year, unless the participant has opted for full electronic delivery. Defined benefit plans, such as traditional pension plans, must provide a paper statement at least once every 3 years. This is a simple but helpful reminder to review your communication preferences and ensure they reflect what you want going forward. Health savings accounts, or HSAs, are another area where 2026 brings higher limits. HSAs are among the most tax-advantaged tools available, offering a triple tax benefit. Contributions may be tax-deductible, the growth is tax-free, and withdrawals for qualified medical expenses are tax-free. To qualify for an HSA, you must be enrolled in a high-deductible health plan, and those qualifying thresholds are changing. For 2026, self-only coverage, maximum HSA contribution, $4,400. Minimum deductible, $1,700. Maximum out-of-pocket, $8,500. Family coverage, maximum HSA contribution, $8,750. Minimum deductible, $3,400. Maximum out-of-pocket, $17,000. Catch-up contributions remain $1,000 for individuals age 55 and older who are not enrolled in Medicare. After age 65, HSA withdrawals for non-medical expenses no longer carry a penalty, though they are taxed as ordinary income. Withdrawals for qualified medical expenses remain tax-free, and HSA funds may be used for Medicare Part B and Part D premiums, deductible expenses, and coinsurance. Medigap premiums are not eligible. As you can see, the retirement landscape will undergo substantial adjustments in 2026, from catch-up contribution changes for high earners, to expanded IRA limits, to new opportunities for small business owners and the self-employed. These updates can meaningfully impact how you save and how you plan for the long term. While many of these changes provide more flexibility and potential advantages, they also introduce complexity. Each rule applies differently depending on your income, your age, your workplace benefits, and your overall financial picture. A financial services professional can help you understand how these 2026 changes apply to your personal circumstances, whether the mandatory Roth catch-up rule affects you, whether you're near an IRA phase-out range, or whether a high-deductible health plan and HSA strategy makes sense for your needs. If you have any questions about the new generation retirement system, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.